So let's go through the Accounting 112 final exam review. So there was a lot of stuff that you guys learned about during this semester, right? We are only going to be touching on a few of the topics that I've noticed students in the past need a little bit of a refresher with. So let's start with question number 1. It says, Rotino Company purchased a new machine on January 1st, 2018 at a cost of $200,000. The company estimated that the machine will have a salvage value of $15,000, and the machine is expected to be used for 20,000 working hours during its 10-year life. We need to compute the depreciation expense under the following methods for the year indicated. So we have those 3 depreciation methods, right? We have the straight line method, the units of activity method, and then the declining balance method. So we will figure out our depreciation expense for straight line in 2018, units of activity in 2018, assuming that machine usage was 1,800 hours, and then the declining balance method for both 2018 and 2019. So let's first work on straight line. So we have all of the important information over on the left. We have our cost, salvage value, its life, and then its usage in 2018. Here in the straight line method, your annual depreciation expense is going to be constant. That's why it's called a straight line, right? So once we find 2018's depreciation, that's going to be the depreciation expense for each individual year. So the way that we find that amount is by taking our cost minus our salvage value, which gives us something called the depreciable cost, and then we take that and we divide it by its life in years. So we plug in the numbers that we know. Our cost, that was $200,000. Our salvage value, that was $15,000. And we divide it by its life in years, which is 10. So if we do all of that, we will find out that the depreciation expense is $18,500. And then remember, when you are using the straight line method, this is constant. So any full year that you have this equipment, it's going to depreciate $18,500. Now, units of activity is slightly different. We still take cost minus salvage, but instead of dividing it by its life in years, we divide it by its life in hours, or its life in units. And then we take that amount that we find and we multiply it by the actual usage. So our actual usage here, that's what that 2018 usage is. We actually used it for 1,800 hours. So let's plug in the numbers that we know. We know our cost is $200,000, our salvage is $15,000, and our life in hours is $20,000. And then we multiply all of that by how many hours we actually used it for, which is 1,800. We do all of that, and we will get 16,650. So that's the depreciation expense under that method. But if they were asking for just the depreciation per unit, that's your 200,000 minus 15,000 divided by 20,000. Just the first part of that equation. That tells us that for each hour, we depreciated $9.25. If you just do that first part of the equation. And then you would take that $9.25, multiply it by the number of hours that you used it for, that 1,800, and that is how we end up with our 16,650. So now let's move on to the declining balance method. So you'll notice there is nothing about cost or salvage in this equation. It brings up book value, which we'll talk about, and then in your textbook, it mentions it as book value times double the straight line rate. What that means is we multiply our book value by 2 over the number of years in its life. Because the straight line rate is 1 over the number of years. So we double that and we put a 2 up in the numerator. Now, book value. What does book value mean? Well, book value is your cost. So for us, that's that $200,000 minus your accumulated depreciation. So how much have you depreciated this equipment for so far? Well, going into its first year, going into 2018, we haven't depreciated at all because we just got this equipment, right? So our book value is our cost of $200,000 minus 0 because our accumulated depreciation is 0. So we take that book value and multiply it by 2 over 10 because there's 10 years in this equipment's life. So 200,000 times 2 over 10 gives you a depreciation expense of $40,000. Now, this question wanted both 2018 and 2019. Why is that? Because 2019, we do things a little bit differently than 2018. In 2019, we've depreciated some. So our accumulated depreciation is no longer 0. So to find our book value, we take our cost of $200,000, subtract out the $40,000 that we've depreciated so far, and then we multiply that by 2 over 10. So it'd be $160,000 times 2 over 10 gives you a depreciation expense of $32,000 in 2019. So you'll notice your depreciation expense decreased from 2018 to 2019. So under the declining balance method, the first year is going to be the most depreciation that you have. After that, it's going to become less and less and less. So you depreciate heavy at the start. So now let's talk about this next question. It says, on May 10th, Jack Corporation issues 2,000 shares of $10 par value common stock for cash at $18 per share. On May 23rd, the company buys back 400 shares for $6,000. Prepare the journal entries for each transaction. So you'll remember, we have a few different kinds of stock that you learned about. We have common stock, preferred stock, and treasury stock. Well, common and preferred stock, those are shares of stock that you issue and other people buy them to invest in your company. Treasury stock is when you go out and you purchase back those shares of stock that were previously issued. So in this problem here, we are dealing with issuing common stock and then buying back shares on May 23rd. So on May 23rd, we're dealing with treasury stock. So let's first look at the journal entry for May 10th. So we are Jack Corporation. And for Jack Corporation, we are issuing stock for cash. So when we want to journalize this, we want to debit our cash because as the company, we are receiving cash in this transaction. Now, why are we receiving cash? Because we issued common stock. So we'll credit our common stock account. So let's figure out the numbers here. So for cash, we're going to take the 2,000 shares, multiply it by the $18 per share, the market price of what we issued these shares for. So 2,000 times 18 gives us 36,000. So we'll debit our cash for 36,000. Now common stock. How are we going to value common stock? Well, common stock and preferred stock are valued at either its par value or its stated value. Here, we have a $10 par value for this common stock. So, we'll take the 2,000 shares that we issued, multiply it by its $10 par value, and we get 20,000. So, we'll credit our common stock for 20,000. Now, if our debits and credits equaled here, we'd be able to move on with our day. But they don't, right? So what happened here is that we issued our shares of common stock at a price higher than our par value. So we got more cash than how we value that common stock. So when that happens, we need to credit are paid in capital in excess of par. A few different ways that you can get this number. First of all, debits and credits have to equal, right? So you could just do 36,000 minus 20,000. That's going to get you the number. But let's talk about how that number really comes to be. You take your 2,000 shares that you issued, and you multiply it by the difference between the market price and the par value. Right? Each individual share was issued at $8 more than par value. So 2,000 times 8 gets you that 16,000. So that's where that 16,000 is really coming from in this entry. Now, the next part of this problem was on May 23rd, Jack Corporation buys back 400 shares for $6,000. How are we going to journalize this one? Well, at the very beginning of this question, we were talking about what we call these shares when we buy them back. We said that they were called treasury stock. Right? Whenever you buy back shares of stock, they are considered treasury stock. So we debit our treasury stock here. And we'll credit our cash. Now, how do we value treasury stock, right? Because common and preferred, those were valued at par value. Treasury stock is valued at the price that you buy it back for, right? So we spent $6,000 here on May 23rd to buy back these shares. So that's how we value this treasury stock. So we'll debit treasury stock for $6,000 and we will credit cash for $6,000. So let's move on to question number 3. So in question 3, it says Langley Corporation has 50,000 shares of $10 par value common stock outstanding, meaning there's 50,000 shares of this stock out there in the world, right? Our shareholders currently have 50,000 shares. Then Langley Corporation decides to declare a 15% stock dividend on December 1st when the market price is $16. The dividend shares are then issued on December 31st. So we need to take that information and prepare the journal entries for the declaration and the issuance of the stock dividend. Now, before we can work on these entries themselves, there's a calculation that needs to be done. We need to figure out how many shares we are giving away in the stock dividend, right? So we're told that it's a 15% stock dividend. So we take the number of shares that we have outstanding, that 50,000, and we multiply it by 15%, or by 0.15. And we'll see that in this stock dividend that we are declaring and issuing in this example, we are handing out 7,500 shares. So we'll use that 7,500 as we are working through these journal entries. So you declare a stock dividend. What does that entry look like? Well, we're first going to debit stock dividends. Now, how do we figure out the amount for stock dividends? Well, we take our number of shares in the dividend, right? That 7,500 that we had to calculate, and we multiply it by its market price. So we take that 7,500 times $16, and we get an amount for stock dividends of $120,000. That's the total market value of this dividend that we're handing out. So that's what we debit. Then we have a couple of accounts that we want to credit here. We first want to credit common stock dividends distributable. So here, to find this number, we take the number of shares in the dividend, the 7,500, and we multiply it by the par value. So 7,500 times $10, because it's a $10 par value, and we get $75,000. So we'll credit our common stock dividends distributable of $75,000. Now, one last account here to deal with, because our debits and credits don't equal, right? When we declared this stock dividend, the market price was $6 more than the par value. And what account do we use here? Paid in capital in excess of par, common. So, again, you could just take the 120,000 and subtract the 75,000. You could get the number that way. But how do you truly find this number? By taking the number of shares in this dividend and multiplying it by the difference between the market price and the par value. So we take 7,500 times 16 minus 10. So when you take that 7,500 shares and multiply it by that $6 difference, you end up with 45,000. So we credit our paid in capital in excess of par for $45,000. So that was the declaration day. Now, end of the month rolls around, and we need to now issue these dividends. This is when we actually hand out the shares of stock, right? At the end of the month. What does this entry look like? Well, we first want to debit our common stock dividends distributable. You'll remember, back when we declared it, we credited that account. So here, we debit our common stock dividends distributable, and we credit common stock, because we are handing out common stock right now. How do we get this amount? Well, we get this amount from the declaration journal entry. how much did we credit common stock dividends distributable for when we declared these dividends? $75,000. So we will debit our distributable account, $75,000, and then we credit common stock, $75,000. So this is for a stock dividend. Now, just working through some of the accounts, if this were a cash dividend. On your declaration day, you will debit cash dividends and credit dividends payable. So if you have a cash dividend, when you declare it, you debit cash dividends and you credit dividends payable. And then on the day that you pay the dividend, you debit dividends payable and you credit cash. So a company gives out dividends, either a stock dividend or a cash dividend, to keep their shareholders happy, right? If a company does super well and they want to tell their shareholders, look at all the income that we brought in, but then they never share that money with their shareholders aren't going to be very happy. So a company will issue stock dividends or cash dividends to keep people happy and make sure that they're seeing that return on their investment. And these dividends are being paid out from the company's retained earnings, right? So in this case, the retained earnings would have decreased by $120,000 because the company had to give out stock worth a total of $120,000. So now we can move on to question number 4. It says Mira Corporation issued 4,000 8% 5-year $1,000 bonds dated January 1st, 2019 at 102. Before we move on, let's break that sentence down because that's a lot of numbers being thrown out. So Mira Corporation is issuing bonds. Why does a company do that? Well, they want to be able to finance a project, right? They need an influx of cash. So a company will issue these bonds and people will pay for the bonds, which gives the company money, and then they will pay these people back down the road. So that's what's happening here. Now, for each of these numbers, the 4,000 is how many bonds are being issued. So we can think back to when we were issuing stock, right? When we were issuing stock, we issued 2,000 shares of stock. Well, here we're issuing 4,000 bonds. Then we have the 8%. The 8% is an interest rate. So whenever a company issues bonds, they then will have to pay interest. And in this case, it's an annual interest on January 1st. So that's going to be 8% interest each year. 5-year, that's our term. That's telling us how long down the road will Mira Corporation pay back these bonds, right? In 5 years, they will mature. The bonds will mature and they're going to have to pay back the money. Then we have the 1,000. The 1,000 is the face value of each individual bond. So each of the 4,000 bonds are worth $1,000. So in total, all of these bonds are worth $4 million. right? If we take 4,000 times 1,000, we'll get 4 million. So, Mira Corporation is issuing 4,000 8% 5-year $1,000 bonds dated January 1st, 2019 at 102. What's the 102? Well, the 102 is saying that Mira Corporation was able to issue these at a premium. So they were able to receive more cash than the face value would dictate. Right? We said that the 4,000 times the 1,000 was $4 million. So if Mira Corporation was issuing these bonds at 100 or at 100% of face value, you could assume that they were going to get $4 million. Here, they're issuing these at 102. So they're able to get 102% of face value. So we'll talk about that more once we are preparing the entries. Then it tells us interest is paid each January 1st. So every single year on January 1st, Mira Corporation will have to pay some interest to the people who have invested in these bonds. So what do we need to do in this problem? Well, we need to prepare the entries for recording the sale of the bonds on January 1st, 2019, recording the interest expense on December 31st, 2019, and then on the following day, recording the interest paid. So we have some of the information there still over on the left side. And we need to record the sale of the bonds. So, as I was saying earlier, why does a company issue bonds? Because they want cash. So we need to debit our cash here because Mira Corporation will be receiving cash. And why are they receiving the cash? Because they issued bonds. So, we need to credit bonds payable. And we were able to issue these at a premium because we issued them above 100, right? We issued at 102. So since we issued at 102, we issued at a premium on bonds payable. If we issued at 99 or at 87, that would be at a discount. So then we would have to debit discount on bonds payable. So now how do we figure out these numbers now that we have our accounts? Well, let's first figure out our bonds payable amount. So this is the amount based off of the face value of the bonds. Your bonds payable will always be based off of the face value. So we're issuing 4,000 bonds, and each of them are worth $1,000. So we multiply those two together, and we get that 4 million that we've already talked about. How about our cash? So our cash, we take our bonds payable amount, that 4 million, multiply it by 1.02. Now, where did we get that 1.02 from? Well, it told us that we issued at 102. That's 102%. So 102% in decimal form is 1.02. So since we issued above 100, we were able to get more cash than the amount of our bonds payable. We were able to get an extra 2%, or if we think about it in dollar form, that's where that extra $80,000 comes from. So now our last problem, or our last account for premium on bonds payable. Again, you could just take the difference between your debits and credits, because you know that your debits and credits have to equal. But how does this number actually come about? It's the amount over 100 that you issue at. So we issued at 102, so that's an additional 2%. So that premium on bonds payable is that additional 2% of the 4 million, which comes out as 80,000. So that's your journal entry to record the sale of the bonds at a premium. Now, on December 31st, we need to record the interest expense. So how are we going to do this one? Well, we have to debit interest expense, right? Because we want to record the interest expense. We aren't paying the interest right now. We said that's going to come on January 1st. So we'll credit interest payable. And then we're debiting premium on bonds payable. What's happening here? Well, you are not only recording the interest expense, but you're also amortizing your premium on bonds payable. It's a fancy way of saying you're chipping away at the balance in the premium on bonds payable account. So when you issued, your premium was a credit. So when you amortize, you need to debit that account to decrease the amount in your premium on bonds payable. So, which account are we going to figure out the number for first? We're first going to look at interest payable. So your interest payable, you calculate that by using your interest formula. Your principal times your rate times time. So your principal is that 4 million, that's your bonds payable amount, times 8% or 0.08 times 1, because it's been 1 full year since we issued. So you do that and you'll find out that interest payable is $320,000. So we'll credit interest payable for $320,000. Now, your premium, we found our premium on bonds payable to be $80,000. So why are we dividing it by 5? Well, we take a look up at the information given to us about when we issued these bonds. They were 5-year bonds. So we are going to divide our premium amount by the number of interest periods. Since this was annual interest, we divide it by 5 because it's 5 years, 5 interest periods. So your premium on bonds payable is $16,000. Then, your interest expense, the way that we find this is taking the difference between our debits and credits. So we take $320,000 minus $16,000, and we see that our interest expense is $304,000. So it's important to remember that it's your interest payable that you calculate using the interest formula. You do principal times rate times time, and that gives you your interest payable amount, not your interest expense amount. Why is that? Because in this next part, we are now going to have to pay the interest. And based off of the information that was given to the people who paid for the bonds, who bought the bonds from you, they expected 8% interest. Well, 8% interest is $320,000. So that's the amount that you are obligated to pay back. So now, interest paid, we will debit interest payable and credit cash for that $320,000. So now question number 5. Question 5 says Hulse Company had the following transactions pertaining to stock investments. Prepare the journal entries for each transaction. So, you are now on the other side of the transaction, right? Back in question number 2, we were the ones issuing the stock. Now, we are the ones investing in other companies. So, this is where we have to think, is it cost method or equity method, right? If it's between 0 and 20% ownership, it's cost method. If it's 20 to 50% ownership, it's equity method. So, in this problem, on February 1st, you purchased 600 shares of Wade common stock for $7,200 cash. That 2% tells you that you own 2% of Wade Company. So, we are well within the cost method for these stock investments. Then on July 1st, you received some cash dividends. On September 1st, you sold some of that stock. And then in December, you received more cash dividends. So let's work on these journal entries. Here on February 1st, you purchased 600 shares of Wade common stock for $7,200 cash. So what are you getting? Stock investments. So we want to debit our stock investments. Then we want to credit our cash because we are using cash to purchase these shares. How do we value this? Well, we value it at the amount that we paid for it, $7,200. So we will debit our stock investments, $7,200, and we will credit our cash, $7,200. Now on July 1st, you received cash dividends of $1 per share on Wade common stock. What are you receiving? You're receiving cash, right? If they are giving out cash dividends, that means that you are getting money. So we will debit our cash in this entry. And we credit dividend revenue. Now, how do we figure out the amount for this entry? It's 600. And how did we get that 600? Well, it's $1 per share. And at this point in July, we had 600 shares of Wade common stock. So we had 600 shares. We are getting $1 per share in this dividend. So we are getting $600. So now on September 1st, we sold 300 shares of Wade common stock for $4,300. So how do we journalize this one? Well, we start off by debiting our cash. Because if we're selling shares of stock, we are going to be getting money. So we debit our cash in this entry. How much cash are we getting? $4,300. So, we debit our cash for $4,300. Then we want to credit stock investments. Why are we crediting stock investments? Well, we're selling some of these investments, right? So when we bought the investments, we debited our stock investments. But since we're selling it, we need to do the opposite. So we credit our stock investments. And how much do we credit our stock investments for? Well, we are going to need to calculate this one. We take our number of shares that we sold and we multiply it by 12. Now, where are we getting this 12? Well, if you take a look back on February 1st, You purchased shares, 600 shares, for $7,200. If you take that $7,200 and divide it by 600, you will end up with 12. So here, when we are selling our stock investments, we need to calculate how much did we initially pay per share of stock. So back in February, we initially paid $12 per share. So that's how we value these stock investments for. So we take the 300 shares that we're selling, times that $12 per share, and we get $3,600. So we'll credit our stock investments for $3,600. Now, you'll notice your debits and credits don't equal. Why is that? We need this extra $700 over here on this credit side. Well, you sold stock investments that to you were worth $3,600. But you were able to get people to pay you $4,300. So since you got more cash than what your stock investments were worth to you on your books, you had a gain on the sale of stock. So if it was the other way around, if you got less cash than what your stock investments were worth, we would have had to debit a loss on the sale of stock. But here we made money, so we credit our gain. So now our final journal entry for this review. On December 1st, we received cash dividends of $1 per share on Wade common stock. Well, if we think back to how we recorded our entry on July 1st, it's going to look pretty similar. We are getting cash, so we want to debit our cash. And how are we getting this cash? It's through a dividend. So we credit our dividend revenue. Now this is where it's going to be a little bit different from our July 1st entry. Back on July 1st, we still had all 600 shares of stock. So we did 600 times $1 per share. And that's how we found our July 1st entry. Here in December, this entry, this transaction, comes after we had sold some shares. So we initially started with 600 shares of stock. We sold 300, so we only have 300 left after that sale in September. So we take that 300 shares that we have left, and we multiply it by our dividend per share amount of $1, and that's how we get our 300 here for cash and dividend revenue in this final entry.